Hello, my name is Jingonelli, and today we are going to be joining an income tax class. But before we join the class, I would like to begin off with a simple prayer. I just pray to the Almighty that He wishes you what you best desire, and He also handles whatever situation you're going through. In Jesus' name, I've prayed. So, guys, with that, before we watch the video, make sure you subscribe to the channel in order to get notifications for other more classes that I'll be posting on the channel.
As I'm saying, what is the composition of business income as per our section 18?
The composition of business.
We said business income means any income derived by a person in carrying on business, and it includes amount of gain or loss on disposal of business asset. That is one. Amount of a gain or loss on disposal of business asset. And we said business asset can take two forms. Either it can be a depreciable asset, it can be a non-depreciable asset. If it's a non-depreciable asset like land or shares, we get the gains or losses on disposal of those assets leads to capital gains, whereas the losses leads to capital losses. The capital gains are taxable in business income, while capital losses are allowable. Or it can be still a gain or loss on disposal balance allowance. Balance allowance is an allowable deduction. That is where you have a loss. And whereas a balance charge is taxable where you have a gain. So that is the first composition of business income, gains or losses on disposal of business assets. Two, we looked at the gross profit derived by a person from disposal or sale of trading stock. If you dispose the inventory, or if you sell your normal inventory in business, that stock, the revenue raised from sale of inventory is included in, it can be a gain or a loss. You can even sell at a loss. The point is that that gain or loss is included in business income. Interest derived by a person in respect of trade receivables. Trade receivables. If you sell on a credit and you have to charge that part, the customer interest, the gain becomes business income. If you are a bank and you have your own loans receivables, and you charge them interest, that interest income is your income. Hits business income. We looked at it's a lot. So you go, guys, you review any value of business asset that is obtained as a result of carrying out on business or as a result of business relationship. Equally, we said it's a composition of business income. After that, after looking at the composition of business income, we looked at non-allowable deductions. Non-allowable deductions. I want to have a summary of them. We'll just review them. Somebody can share with me. What are some of the non-allowable deductions?
Any expenditure or loss incurred by a person to the extent to which it is a domestic or private nature.
Very good. Any expenditure incurred by a taxable person which is of a private nature or domestic or for domestic purpose. That is 1. 2, guys, I want you to note these things. We have started from composition of business income. Now I'm going to non-allowable. Then after we'll go to allowable as a simple review. And then we'll go to those that are specific, which we are supposed to look at. That is 1. Thanks for that. What else? Okay. Any tax payable in Uganda or a foreign country, equally, that is also, in short, income taxes. All taxes are non-allowable. What else?
You look at any gift made directly or indirectly.
Any gift
made directly or indirectly.
Any expenditure or loss which is recoverable under any insurance contract or indemnity.
Very good. That is also it is non-deductible. If you have any expenditure or loss, but it is recoverable, implying you are insured. What else? Who is not registered for tax purposes or who has no tax identification number, which is above one transaction from a supplier that has no TIN, is not allowable. Computation. I would presume that you know them because I've taken time to show you know them. Small as they are, they will be hitting a lot of our discussion. Yes, what else? Guys, all those expenditure, if they are incurred, we add them back. They are non-allowable. So where you found that the financial accountant charged it as an expense, what you do is you add it back. As if you find any of that expense, the financial accountant could have charged it as an operating expense in your income statement as an expense. Remember, we said we have two accounting. We have the tax accounting, and then we also have the financial accounting. The financial accounting follows GAAP. So the accountant will charge all those as operating expenses. So for tax purposes, we add them back because the income tax does not allow it. The law does not allow them. You find them, please, you add them back. Okay, and what are those that are allowable? We've looked at those that are non-allowable, and those that are allowable, what did we say? We have those that are general and specific, and we looked at those that are general. Those that are allowable, guys.
Local service tax paid by an individual.
Local service tax paid by an individual, very good. It's an allowable deduction, and we said that is much met. You'll be finding it so much in when you go to employment income. What else? What else, guys? Yes. Expenditure or loss, good, which could have been incurred by the person during the year of income, provided it was included in driving that income included in the gross income. It's allowable. What else?
Local service tax paid by the individual.
We saw that. Somebody has mentioned that. What else?
The expenditure or loss must be revenue in nature and not capital.
Okay. Of revenue nature. What else?
2% of income tax paid by private employers who proved URA that 5% of their employees are full-time basis is persons with disabilities.
Very good. Those employers who proved to URA that 5% of their employees are employees with disabilities, they are allowed 2% of their tax payable. It's not chargeable income, it's tax payable. In short, you first determine tax before considering it. Then later you go back and allow it and go recompute the tax payable. What else? Etc. Now we look at those that are a little specific, which you have there in your reader. And the first one, we have meals and refreshments. Meals and refreshments. Now, what is key, guys, in meals and refreshments? They are around there are around two things that are much important here. The value of meals and refreshments or entertainment, if they are included in the employee's computation of chargeable income, or if they are included in employment income, they will be allowable. That is one. So they should have been included in the employees. In short, they should have been taxed under, or they should have been included the employees in the employment income. Then two, meals and refreshments must be available. Those meals should have been available or availed to all employees on equal term basis. If your business is not necessarily for providing meals, or you are not a restaurant and you are meals, everyone, inclusive of the principal, inclusive of everybody, inclusive of the non-teaching staff, they should be entitled to those meals and refreshments on equal term basis. Either they are provided at the company premises or they are provided on behalf of the entity by someone. Like you have a hotel where you pay or subscribe and we all go and eat from there. But the point is that they must have been included in employment income, and then two, they must be provided on equal term basis. Those are meals and refreshments, guys. You will need to give them time to read and understand what is exactly allowable. They are covered in section 23. I ask you a question, guys. Is entertainment allowable?
Yes, if it's given to all the workers.
Good. If it is given all the workers, it is okay, it's allowable. Or if your business deals in entertainment. So in short, if you find entertainment and you are not sure whether it is given, if there is no additional note, you first add it back, unless if there is additional information showing that the entertainment was given to all the workers for the given period of time, where they were contributing to the raising of income. Bad debt. Bad debt. Yes. That is very true. What you are saying there is okay. We first add it back, then we look at the provisions of the tax. Does it qualify as per the law? I like that person, guys. My network today is very bad. I don't know what's happening. I'm going to be on and off, guys. Apologies in advance. Bad debts, guys. Guys, bad debts, it's an interesting one. There is even a case of ATC versus URA.
Excuse me, sir.
Yes.
I want to know the meaning of some point.
Yes.
Arm's length consideration.
Arm's length consideration?
Yeah.
We mean should be at the market price. Arm's length consideration. A consideration is just like a price, but we mean market price. For example, it's common for companies that are related. Assuming we have part and part has another branch. Then the transaction between, in most cases, let me go to be practical. MNCs, multinational corporations, they charge themselves. Like I'm going to give you a case of, I'm going to share with you when you got interest on bad debts. There is that case of ATC versus URA. And this gives the other person a loan, but the loan is, they later capitalize the loan. But the point is, when you are related entities, you are required equally. They will allow something where you have charged yourself a price, which is the general market. Other than that, that price is not deemed to be at arm's length.
Okay, okay, sir.
I hope you get it.
Yes, sir.
Okay. So guys, bad debts, we are saying bad debts is a little tricky and it's a common one you're going to be finding every now and then, every number. Bad debts, it's where we don't specific bad debts that have been written off. Before they used to consider bad debts provisions, but now the act exactly looks at bad debts written off. So where, or you gave someone a loan, the client, and this client can't pay you, you have to prove that the client, that the bad debts which were written off, you did whatever it takes and you have failed. So where you fully write off the bad debts, that alone does not qualify it to be allowable. However much they are written off, you must prove. And how do you prove that bad debts are written off? You need to show the one, that you did all the necessary steps to ensure you recover that money and the client has failed to pay. That is one. You must show proof that you tried whatever it takes. You did all the reasonable steps to recover your money and you failed. That is one. Two, you need to show documentation for approval of that write-off. Like the board sat or management and agreed to write off after trying to recover their failed. The board sat and wrote off the bad. Those companies, if it's a big debt and it has almost forced the company to go into liquidation, you need to show evidence you have been rendered bankrupt or you have gone into circumstances that they may accept. You may even went with this client into court and the client is still refusing to pay. So legal documentation, all that, following up that debt write-off may all be necessary. URA doesn't just allow that bad debt. So you need to prove. Right, guys? That is the bad debts for you. You will read it. We look at interest. Now, how does interest arise? Interest is on debt obligations. We look at interest mainly that arises as a result of debt obligations. When you borrow, and when you borrow, the interest on the debt or on borrowed funds is the one we are looking at. Remember, we said that debt, for whatever in your finance you studied, they told you that debt is tax allowable. However, not every interest is tax allowable. You must know. We need to know what is the composition of that interest that is allowable. One, the interest that is allowable, guys, is that it must have been incurred to raise the income that is included in the gross income. You are allowed a deduction for the interest incurred during the year of income in respect of debt obligation, to the extent that the debt obligation has been incurred by the person in production of income included in the gross income. That is very key. Not debt for other specific purposes. It must be for business purposes. And it must be relating to that year. However, the Act allows interest it allows interest in that period. If you can't recover all your interest, you can other two years. It allows 3 years. So in short, you are allowed in the current year in which you are borrowed, and in other 2 years. Those are 3 years. You can recover your debt, but they allow up to 30% of your tax EBITDA. Guys, interest allowed is 30% of the tax EBITDA.
No, sir, kind of right.
Interest, guys, you are allowed interest provided they are arising from debt obligation in the year in which you have acquired the loan. or if it was incurred specifically to contribute to the income that is included in the gross income. That is one. That is the general rule. However, what is allowed of interest, guys, should not exceed 30% of that interest. You are allowed up to. Interest is allowed up to 30%. 30% of tax EBITDA. 30%, you don't exceed 30%. You cannot list somewhere for that year of income. The big note, guys, because you are going to, you will find this and you will have to, you are allowed interest up to 30% of tax EBITDA. What do we mean by tax EBITDA? We mean earnings. However, those earnings, we are calling them tax EBITDA. So it means they must be earnings that have been computed following taxation principle, not accounting profits. They must be your earnings that have been followed using tax. Do we get it, guys?
We are getting.
You are saying? What, Wanji? I'm not getting your question, Mary. You can repeat for me. They tax interest. Question? Is there a situation where they tax interest? I don't know. I don't get your question well. They deduct or they tax? No. Unless if it doesn't result into, or it was not specifically you borrowed, but the debt borrowing or that debt obligation is not for if it's for other purposes and you are allowing it as an expense, they will add it back. But if it's for earning incomes included in the year of income, or if it was generally for business purposes, they will allow it. However, what I want you to note is they allow up to 30%. They don't allow everything. And if you can't be recoverable, they give you extra other 3 years. So it can be carried forward. Very good. They don't tax interest unless if it doesn't relate to business and you are showing it, you can't prove that it's for business and you're allowing it as an expense, they will add it back. So if they add it back, it implies it will be taxed. I hope you follow. Does it make sense to you? Good. Now, guys, there is a case regarding that interest, and the case here is for ATC. Now, ATC is a Netherlands company, and it's a branch, but it's owned 99% by a Netherlands company. In your free time, you can Google that cases are online. It happens that they got a loan and it's 24 billion. The interest was 24 billion, which they were the URA was in actual sense URA was gave them an assessment of 24 billion as withholding tax. Remember, interest, guys, interest is taxed at 15%. If it is an interest income, not an expense. And then they gave them, they were saying, since it's a loan rate from a rated party, they were taking it to be taxed. And these guys, they refused. They were using a case where if you got section 47, section 47 says that interest in form of any discount, premium, or deferred interest shall be taken into account as it accrues. So it implies it's allowable as an expense. Whether it has not been paid, it's allowable. But when you look at that case in your free time, if you can get time, you can go look at it. But for you, what you need to take note of here is that interest is an allowable deduction, provided it has been incurred on the borrowed funds, which were included in the year of income, which they obtained their own specifically for business purposes. And how much is allowable? It's up to 30% of the tax EBITDA for that year of income. if you can't recover, if the interest exceeds 30%, that what has been charged in the income statement is exceed 30% of the tax EBITDA, then you are allowed to recover it or to claim it in other subsequent years. It's carried forward. Repairs and minor capital equipment. Repairs and minor capital equipment. Yes.
So I beg your pardon on tax EBITDA.
Yes, tax EBITDA. What do you want to know?
Like the meaning.
We mean earnings before interest and before earnings before interest, depreciation, and tax. However, which has been computed not for the accountant, but which is computed following tax principles. I hope you follow it.
Yes, sir. Thank you, sir.
You're welcome. Next one, we look at repairs and minor capital equipment or expenditure. Guys, repairs and minor capital expenditure. Here we have around two things. We have the repairs and then minor capital expenditure. If repairs, if the repair expenses incurred for the year of income for the income included in the gross income, or to try to generate income that is included in the gross income, they will be allowable. They are allowable. However, the minor capital expenditure, if you incur some expenditure, if it's capital in nature, but its value is below 1 million, the act says below, not 1 million. So if it is 1 million and above, it is not allowable. It's capitalized. But if it is below 1 million, guys, it's allowable. However, it must be, you must prove that it has capacity to function independently. That is very key. You must prove that it has capacity to function independently. Do you get it, guys? Do you get repairs and minor capital equipment or expenditure?
No. Sir, pardon.
Guys, do you get repairs and minor capital expenditure?
No. I beg your pardon.
Yes.
Pardon.
I'm saying repairs, if they were incurred, you are repairing or you are doing your construction, and those repairs were incurred in production of income that is included in the gross income. That expense regarding the repair will be allowed, like painting or what? It's allowable. Then, which is below 1 million, any expenditure you incur on capital equipment, but whose value is below 1 million. Guys, the cost, the standard says that cost you are incurring or the expenditure should be below 1 million. It's allowable. However, there is a condition there that that equipment should be in position to function independently of other assets. I'll give you an example there. You know the desktops, the computers.
Yes, we know them.
It needs a CPU, so you realize it can't function alone. And its value is below 1 million. So that one, because it doesn't function alone, it cannot be allowed as it's not allowable. So here we are interested in those that functions alone. For example, it can be a laptop. A laptop whose value is below 1 million. Like those small laptops, those small minor laptops. Since it functions alone, separately or independently, that one will be allowable. Then we have research and scientific expenditure. Research and scientific expenditure. Now, research and scientific expenditure, here you conduct a research during the year of income, and it is included in your gross income, or it is that research is to contribute to income that is included in your gross income. However, it takes two forms, and I want you to understand those two forms. One, the research can be for your own benefit. Maybe you want to come up with new ways of doing things as a business. 2, you are, I've told you, one can be for your own benefit as an organization. You are improving your ways of improving all your systems. You are improving the way you carry out your business, and you carry out an investigation or a research. Like you want to come up with, say, intangible assets to develop new products, it is okay. That research, it is allowable. As the cost you incur to conduct the research is allowable. 2, the other context is where you incur research, but you are facilitating a research institution. You are facilitating a research institution, or you are contributing towards the research institution. Like, for example, MOOBS is one of them. It's a research institution. It's a university, and therefore it conducts research. Now you can partner with MOOBS or any research institution. Like there is that Makerere research institution. You pay, you partner with them, but they are hoping you to come up with, say, with new ways of doing things in your business. It should, in short, it must be relevant for your work. If it is not relevant for your work, they will not allow that research expense. However, there is only one exception to that. It should not be related. It excludes expenditure incurred for acquisition of depreciable assets. It excludes. So it should not be related to acquiring assets which are depreciable or intangible assets. You will get time, you go through it, you read that paragraph. Training expenditure, guys, training expenditure, that one is allowable for the year of income, provided the expenditure you are incurring in aggregate. The expenditure you are incurring, they are saying that an employer is allowed a deduction of expenditure incurred during the year of income for training or tertiary education, or not exceeding the aggregate 5 years of a citizen or permanent resident of Uganda, other than the associate of the employer who are employed by the business in business, the income from which is included in the gross income. Permanent resident, blah, 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 those ones, you know who is a permanent resident. But the point is, guys, is that training expenditure you incur is allowed, provided that training is in aggregate does not exceed the 5 years. So if you find a training expenditure, it will be allowable for that period you are looking at it. Donation is another tricky one. It has a lot of, when you look at the act, it has a lot of conditions. Now, donations that are allowable are the charitable donations. In most cases, to the exempt organizations. Exempt organization, the list is endless. When you go to section 20, it's where it is covered. The list is very endless. So in your, it's a lot. But what you need to know is what is the test to confirm? There is somebody raising the hand. Call the Zoom user. You can talk. Guys, donations, it's allowable it's an allowable deduction, and it's only allowable if it's given to charitable organizations. So you must know what are those charitable organizations that qualify. And it is only given, guys, in the charitable organization, or what we've called the exempt organizations, as per URA. Those exempt organizations, they must be given what we call the exemption certificate by the Commissioner General in force, or the Commissioner General who is in power by that time. If donations are not to charitable organizations, guys, they are not allowable. So yours is need to find out, are those donations to the charitable organization? If yes, like for example, a listed institution can be to government organizations. It can be to those like the Sanyu Babies Home. If there are those donations, they are allowable. In short, any charitable organization. But we've said the charitable organization is that organization that has got exemption certificate. And the exemption certificate is given every after 2 years. They assess whether you should be exempt in every after 2 years, and they list you on the portal for URA. So it's not a must that if you are given exemption certificate, it will continue to operate. After 2 years, you must go and renew your exemption status with URA. However, how much do they give? Guys, what is allowable is up to, they allow up to 5%. The allowable should not exceed 5% of the chargeable income. That is what you should note for you, for your computation purposes. Is somewhere there. The amount of deduction allowed for the year of income shall not exceed 5% of chargeable income, calculated before taking into consideration donations. Here it is. That is the note you should learn. So you first determine your chargeable income before you consider donations. Then you multiply by 5%. I hope it is okay, guys, to you.
Excuse me, sir.
Yes.
Excuse me, sir.
Yes, I'm listening.
About the training expenditure,
Yes.
what they mean by other than an associate of the employer who is employed by an employer in the business income.
We look at a related party other than the associate of the employer who is employed by the employer in business. It should be to your general employees, but not a related party. We look at assessed losses brought forward or carried forward. Guys, I'm not going to go through everything there. But what the learning in assessed losses is, what do we mean by assessed losses? What you must know. For the year of income, remember we said how do we determine chargeable income? You look at your gross income, you less allowable deductions. Then you derive what we call chargeable income. Now, being that after getting your gross income, less chargeable income, less allowable deductions, you get a loss. Now, if you obtain a loss, implying that is a loss that is obtained following the taxation principles, that loss is allowable. You don't pay tax for that year. And if the loss will be carried forward, you are allowed. The loss of the previous year is going to be an allowable deduction in the current year. So if you don't claim in this year, you will claim next year. You will be allowed that to the extent that you made that loss, the total loss you had, provided it is following the tax principles. Guys, assessed loss, I've said, is where you make a loss during a given year, like where after getting your revenue and other incomes, less operating expenses, you obtain a loss. However, it must be that loss that is following taxation principles. So how do you determine the loss? After obtaining your chargeable income, do you know how we get chargeable income? You look at gross income, then less allowable deductions. You put gross income less allowable deduction, then you should be getting chargeable income. So instead of chargeable income, you have a loss. That loss is going to be allowable in the subsequent periods. The whole of it is allowable to 100%. You are allowed it. You carry it forward and you are allowed to offset it as an allowable deduction. Startup costs. Startup costs, what do we look at here? You are starting up a fresh business and you incur in the process of coming up with a new business, you incur a lot of startup costs. You incur costs. Like what? Like those preliminary costs when you are starting. They could be maybe costs for conducting research, survey, cost on professionals like lawyers, accountants. The act mentioned is some. Excuse me. The act mentions legal costs, various advisory costs, registration charges, cost for promotion and advertising at the start, or preliminary costs when you have just started. In your free time, you can go visit section 30. Now, those costs, guys, are allowable. However, they are only allowable for 4 years. They should not exceed 4 years. And how much are you allowable? You are allowed 20. You are allowable. You are allowed 25% per year, up to 4 years. So each year you claim 25% up to 4 years of those startup costs. I hope you get it. Then equally, if you have an initial public offering is that you are going public, like you are getting to be listed on stock exchange, like what MTN did. MTN did its IPO in 2022. When you look at Umeme had its IPO in 2013. Now, when you go public on stock exchange, you incur a lot of costs like underwriting costs, etc., like the brokers costs. All those costs are allowable to those companies that are going public for their first time. When you go check in 2002 is when they made that amendment to that section that you are allowed. But what is to note here is that you are allowed up to 25% of that total cost per year for the 4 years. So in the year in which you incur the cost, you are allowed 25%. Then you are allowable other extra 3 years. You don't exceed 4 years. I hope you get that. Cost of intangible assets. Cost of intangible assets. Any cost we incur on intangible assets, guys, provided it has a sustainable useful life. Provided it has a sustainable useful life. That intangible asset you are developing or you are incurring on, if it has a useful life which is known, you are allowed that cost over the useful life of the asset. And how do we get it? It's A out of B, where A is the amount of the expenditure incurred or the cost incurred, and B is the life of the asset. In short, you are amortizing it. It's like how we compute amortization or depreciation. You get the cost of the asset, divide it by the useful life. Guys, we have legal and professional fees like audit fees, consultancy fees. Normally those are allowed, and in most cases I've said that they are allowed as part of startup costs. Premiums or interest on short-term leases, they are also allowed. The interest, I hope you did, I don't know whether you did IFRS 16, but interest on the short-term leases are allowable. I'm going to request you go through all those. I want to look at the initial allowance, guys. Initial allowance has a lot. It's among the capital deductions. Do you see this? Capital deductions. Capital deductions or costs. Capital deductions, sometimes we call them costs. These are expenses which are incurred and are of capital nature. And the common one we have here is depreciation. But depreciation, the one which is computed by the accountant, is not allowable. that one noted from the start. We add it back. Depreciation that is computed by the accountant is not allowable.
Pardon, sir.
Capital allowances, the common one I've told you we have is depreciation. However, the depreciation computed by the accountant, the financial accountant, is not allowable. Why? Companies have their own operating policies, company policies, which differ from company to company. Others use straight line, others use reducing balance, others use sum of years digits. And it's a management estimate. It depends on what the company plans. So not every depreciation, in short, depreciation by a financial accountant, the ruling is easy. It's not allowable for tax purposes. It is added back. What is allowable is wear and tear. The wear and tear is also depreciation, but following taxation principles. So it's the common one we look at under capital deductions or allowance. So this will take us to the different classes, and we see which classes and how are they categorized. Before there were 4 classes, and currently they are categorized into 3. Depreciated at the rate of 40%. We have 30, and then we also have 20. Before there it was 35. Now the 35 was removed. It was charging a lot. It was reduced. In the last year's amendments. So under those capital deductions, guys, we have wear and tear, we have initial allowance, and industrial building, then farm capital deductions. I want to cover wear and tear. No, initial allowance. Wear and tear has a lot. It involves all those 4 classes that will need a day. And after, I think, one more meeting, I think by the end of this week, we should be finishing all the theory. Then when we meet next on physical, we do the computations. So on Friday, I'm going to be finishing up the theory bit. And then when we meet, we do the computations. So I want to look at initial allowance, and if okay, I cover the industrial building. Then I will cover wear and tear and farm capital deductions next time we meet. So initial allowance. Now guys, initial allowance, that thing was repealed. It was repealed. When we say repealed is when it was removed. It was first removed in 2014 and later brought back. However, in 2014, when it was before it was repealed, they used to give you an initial allowance for a given, guys, initial allowance reduces the tax for you. They give it to you as an allowable deduction to reduce the wear and tear you're going to charge for the asset. So in short, it is a benefit to the company. They reduce for the capital base on which they are going to charge you wear and tear. So it's an allowable deduction and therefore benefit to the company. So initial allowance, before they used to give it to companies. And then 2, if you are putting any property for the first time into service, and later, after giving you initial allowance, they were also giving the wear and tear in the same year. However, now it doesn't work that way. We are going to see how it works. So when you look at what we have there, we are saying that initial allowance is a deduction given to a person who places an eligible, that is a key word to note, eligible property into service outside 50 kilometers from Kampala. Any person who places an eligible property for the first time into service outside the 50-kilometer radius from Kampala, you are given an initial allowance. So you are saying, what is the eligible property? It means plant and machinery, wholly used in production of income included in the gross income, wholly used in production of income included in the gross income, during the year of income. However, it excludes goods and passenger transport vehicles. So it's not there. Initial allowance does not work for cars. Goods and passenger transport vehicles. Household appliances, it doesn't work to them. All those household equipment. What are some of the examples, guys? Then we also have household furniture and fittings. What are the examples of household appliances, guys? Which are used for household purposes? The ladies should help us here. What are the examples? The Act doesn't specify what are the examples. So for you, when you allow it, they come and reason it out. The ladies, you can share with us what are the examples of household appliances.
Refrigerator.
Yes? Refrigerators. Yes, that is one. What else?
Washing machine.
Washing machines.
Television.
Televisions, we have hoofers or the system.
Flat iron.
Etc. At the point,
Robot.
a robot. Is a robot a household appliance?
Yes.
A percolator.
Yes.
A robot for babysitting.
Somebody who says a robot. Is a robot a household appliance?
It can be a babysitter.
It can be a babysitter. I should
It's
buy
funny.
one. I should buy one at home, I think.
Yeah.
All right. My point, what I want you to learn is that you need to know what is eligible property. Plant and machinery, wholly used in production of income, including the gross income, but does not include goods and transport passenger vehicles, appliances that are ordinarily used for household purposes, offices and fixtures and fittings. Guys, all those are not included. So if you buy, provided, guys, it must be put for the first time into service outside the 50 kilometers, a 50-kilometer radius from Kampala, you are going to be given that initial allowance. And the initial allowance is 50% of the cost base. However, guys, you note this, it is not in your reader. For the first time, guys, you are given, when you claim for initial allowance, you don't claim for wear and tear. You should note that. It is not in your reader. In the year you claim initial allowance, you don't take wear and tear deduction. That is the current amendment. You take one. You either take initial allowance, but then you forego wear and tear. I hope you get that.
I beg your pardon, sir.
Yes?
Pardon.
Pardon about initial allowance and wear and tear.
I'm saying in the year you claim initial allowance, you don't claim, you can't take both. Before they used to take both, before 2014, you could claim initial allowance and also you claim wear and tear on the same asset. Here you only claim one.
Excuse me, sir.
Yes.
Is initial allowance also for?
Is initial allowance also for?
Yes. Or it's only for the 4 years.
Is initial allowance for what? I'm not. Is it for 4 years? You are allowed initial allowance for the first time in the year you first put in that first year only. So it's for 1 year. They are promoting development. So if you do come up with any machinery plant and you are putting your plant outside the 50 kilometer radius of Kampala, you are in short, you are developing that area because everybody is getting concentrated in Kampala in the central. And in the central, if you look at 50 kilometers from the central, guys, if you are from Kampala, if you are from Kampala to Jinja, those are around 69 kilometers. Is it true? They are around 69 kilometers. So it implies you must have, if you are within Mukono, you will not be entitled to the initial allowance. If you are in Mukono or Wakiso areas, Entebbe, because Entebbe is around 30 kilometers off Kampala. However, the 50 kilometers has a challenge in determining it. It's a tricky one. So it involves a lot of valuation by URA people. I will not deceive you over that. But mine is for you to learn. I want you to get to know that that's what the act says. Tomorrow, if you are in practice, you have to go face the URA guys and see how they actually use it. I think even in PG doesn't qualify. It's like after MPG. If you put any facility after MPG is when you can start to qualify for that initial allowance. But the objectives for development. We now look at that was for general initial allowance. Then we have the one for industrial building. Initial allowance regarding industrial building. Industrial building, for it is 20% of the cost base, whereas the general one is 50% of the cost base if it is that asset or plant and machinery is put in for the first time for production of incomes, including the gross income, in the radius that is above 50, which is 50% of Kampala. But the one of the industrial building initial allowance is that deduction allowed to a person who puts into use for the first time during the year an industrial building other than approved commercial building. Someone who puts into a building for the first time during a given year of income other than the commercial building, other than approved commercial building. So in short, they are giving buildings, but not commercial buildings. They are giving them to industrial buildings, those buildings that are used for production or factory. In short, they are factory, but not these commercial buildings for your rental purposes or which you use them for day-to-day business. It is specifically for industrial building. So this is mainly to the industries. And how much do they give us the initial allowance? What I want you to note here, how different it is in terms of the computation. The industrial initial allowance on industrial building is 20% also on the cost base. Even the other one is 50% on the cost base, provided it is an eligible property. And you need to know what is eligible property. But for the one of building, it is 20% on the cost base of the building. However, for it, you are given initial allowance and you are given at the same time, you are given the IBA or the IBD, the industrial building deduction, which is, IBA is the industrial building allowance, which is depreciation at 5%. So here you are given both wear and tear and initial allowance. That is if it is industrial building. But if it is an eligible property, you are only given 50% and you don't claim. You don't claim wear and tear in that same year. So those are key areas that you are going to be affecting our computations. For industrial building, guys, I repeat, you are given both the initial allowance. If you put it for the first time, you are given initial allowance of 20% of the cost base, and in the same year, you are given IBA, the industrial building allowance, which is depreciation or wear and tear. But for eligible property, you are only given the initial allowance, but you're not given wear and tear. I hope you get it. I want to cover related to that industrial building allowance. IBD industrial building deduction or IBA, it's the same. Industrial building allowance. An industrial building, in terms of the definition, what does it mean? Any building which is wholly or partly used or ready for use by a person in one, any building that is wholly or partly used or ready for use by a person in one manufacturing operation. We check around page 11 or 15. One is used in manufacturing operations. Two, research and development into an improved or new methods of manufacture. Three, mining operations. Four, approved hotel business. For example, like hotel, when you look at Serena Hotel, I told you that I audited their accounts of 2017, 2018. In that year, they had 23 suits that they had decommissioned to operate. They had manufactured new suits. Now, those in the year they first put them into use, they are supposed to be given that initial allowance, but at the same time, they claim IBD. That is approved hotel business, then approved hospital or approved commercial building. They are saying where that note where a person has incurred the capital expenditure in the year of income on the construction of an industrial building. You have seen what is an industrial building, and the building is used in production of income, including the gross income. The person is allowed a deduction for depreciation of the building during the year of income, which is calculated using that formula. A times B times C out of D. A is the rate applicable, which is 5%. B is the capital expenditure you have incurred in coming up with that building or that asset. However, reduced by initial allowance. So in short, you first compute initial allowance 20%, then the reduced value is what you subject here, or the net book value after removing initial allowance. I hope you get that. Is the capital expenditure incurred in the construction of the building reduced by initial allowance. So that net cost after you have offsetted the initial allowances is the B. So don't bring the cost yet you know it qualifies for initial allowance, guys, it will be wrong. Then C is the number of days in the year of income during which the asset was used or was available for use in production of income, including the gross income. The number of days. How many days have you used that building for that year? Implying we do apportionment here. If you use the building, like that year we audited Serena, it had used it from October. From October, November, and then December. There are 3 months. So it implies you first give initial allowance, it's going to be 20%, the whole of it. And then after 20% of the cost, you now compute depreciation of, say, if I give you that example of Serena, you now compute depreciation, which is now 5% times the value multiplied by the value after removing initial allowance, multiplied by 3 months out of 12. But we use number of days. So you compute the number of days. We present it in terms of days. Then D is the number of days in the year of income. Where an industrial building is only partly used for prescribed uses, the amount of the depreciation deduction allowed shall be apportionately. Like if you use it half for production of income, half maybe for personal use or for other issues, you apportion it. You only the deduction is only allowable only that is related to production of income, including the gross income. Where an industrial building is only partly used by a person during the year of income prescribed use, and the capital expenditure incurred in the construction of that part of the building for the users is not more than 10%. Expenditure is not more than 10% of the total capital expenditure incurred on the construction of the building, the whole of it is treated to be used for prescribed use. What do we mean here? That if you have an industrial building, but you are using it partly to do other businesses and partly for the business in the context you are looking at, or for prescribed use, which we are looking up, which we saw up there, an approved commercial building, we saw a hotel business, we saw mining. So if you are using it for other things that is not approved, however, if that part does not exceed 10%, the whole of it is going to be termed or interpreted to have been used for the prescribed use. The amount of deduction allowed is not to exceed the amount which apart from making the deduction would reduce the expenditure at the end of the year of income. There is the last one, which is interesting. Where it is bought, we are talking about industrial building. It is bought and sold together with land. So it is part of land. It involves land where it is. The value of land shall be the difference between the total consideration and the value of the building. So if it is bought and sold together with land, so remember, land has to go for capital gains. So they will have to first determine what is the value for the building. So what cost did you incur to construct the building? They will have to determine that cost, then they get it different from the cost of land. So the land can be computed, the capital gains on it. That is URF for you. Guys, I beg to stop here. You go through it.
Good night.
We will meet for wear and tear and the farm tools. Capital deduction for farming.
Good night. Thank you, sir.
You're welcome. We meet on Friday, and then next week we start our computation. Even next Friday, we'll be dealing with the theory. Then computations will start when we go physical.
Thank you so much for watching. Make sure you subscribe to the channel.